The next session will be a discussion which will focus on the creative ways that traditional lenders and fintech companies are collaborating to change the lending landscape, increase credit availability, and speed up real estate finance. Our next session discusses the ideas on the next wave of embedded finance and API-led services, potential sectors which could benefit from these partnerships. And to do the honors, may I call upon our moderator, Ankit Uppal, who is a partner at BCG. May I have Ankit take stage, please? Thank you. And speaking with Ankit on the panel, we have Rohit Taneja, who is the founder and CEO of Decentro. Rohit Taneja. Along with Rohit, we also have Amit Boni, who's the founder and CEO of Ensuredit. Joining them is Pramey Jain, who's the founder and CEO of Tartan HQ. And we also have Anant Deshpande, who's the co-founder Finbox. We will be taking questions at the end of the session, and we are running a bit late. So may I request the audience to minimize the questions to just two, so that the next sessions can move on as planned. Request Ankit to take it from here. Thank you.
We'll run the discussion in three parts. I'll just quickly start off with some teaser questions for all of our distinguished panel members, after which we'll get into the thick of the conversation on embedded finance and API-led services, and we will end with a quick Q&A round as well. So maybe without much ado, let me start first with you, Rohit. You've previously founded MyPoolin, which eventually got acquired by PayU, right? How do you see this market playing out over the next 3 to 5 years?
You mean the market of embedded finance? Okay. Yeah. Interesting, the market has just started. So, it's obviously it's too early to make predictions anyways about any market where we are in the early infancy stage. But I think one of the things which is super interesting is the level of interest that we are seeing, especially from e-commerce, the incumbents in trying to introduce finance, right? And I was just telling somebody yesterday, one of our investor friends, that the tagline of a fintech festival should be "All roads lead to lending," and that is exactly what is happening, and it's very natural, right? Very natural extension that once you start, getting your first set of customers, you sort your payments, you sort your onboarding, then you immediately start thinking about making money, and lending is the easiest way, the most natural way, right, to start making money. So yeah, I think too early, of course, from a evolution how it would look like, but embedded finance seems like the clear direction, because if you look at everybody's shopping habits or just everybody's purchase habits, people are just used to trusting the brand where they shop the most or open up the most, right? And hence Amazon, Flipkart, everybody trying that. That definitely seems like a clear direction. The second interesting thing will be where a lot of these banks and non-banks will work together on co-lending arrangements, right? And of course, some of it is already happening, but again, we've just scratched the surface there. Extremely powerful space, just from a co-lending perspective. Yeah, that's, I would say, my 2 cents initially on, how I see the space. Yeah.
Thanks, Rohit. Amit, you've yourself been an industry veteran, having previously worked with Motorola in the capacity of managing director, and before that as chief business head of Matron. You picked up a very interesting space, where there are lots of friction points to be solved. At Ensuredit, how are you really solving for those?
For us, insurance is essentially something that's very, very meaningful on an everyday basis. One of the things that everyone keeps on talking in insurance is the penetration rate. We talk about it in actually 2 forms. We talk about it in terms of penetration, but we also talk it in terms of protection gap. The good thing is, insurance is a very data-dense industry, and that data has already been there. APIs, technology, online, doesn't matter whether they existed or not. A lot of that data sits in PDF files and on Excel sheets and plain paper. For us, it became a question of how do we kind of bring a lot of that together? How do we bring that intelligence together? And how does that then start dovetailing into really making a difference in what kind of distribution should be done and what should be those modes of distribution? If you see most of the insurance companies, on their balance sheets, the cost of distribution is sometimes as high as about 40-45%. So how do you really go down a path in which you can make insurance accessible? So solve the problem of accessibility by making cost of distribution probably like 10x lower than what it today is, and then bring in more context relevant products. And data helps you kind of look at both of them, and it becomes a very interesting virtuous flywheel. So for us, that's the playbook that we have.
Fantastic. Pramey, you yourself been a banking practitioner, having worked in analytics function, several banks in different capacities. Interestingly, you've recently launched a product, Patek, which looks at employee solutions, especially for employers who are looking to solve the emergency credit needs of their employees. Can you shed some light on what this product is about and what pain point are you really solving for?
Thank you, Ankit. So basically, Patek is now actually rebranded as Perks already. So it's been almost a year we are running the product. So essentially, it came out of the customer demand that we were getting. So essentially, probably I'll have to touch upon what exactly we do. So basically what we did was we built a lot of connectors on work platforms, HRMS system, payroll systems with multiple use cases. One was income and employment verification for lenders, for group medical insurance, the GMC partners would need it. There were a bunch of other use cases. While we were integrating with payroll work platform systems, a lot of employers, platforms demanded, can you enable or embed financial products on top of us? So that's how we started. We quickly built out a few products with some of our partner customers, and we launched a product called Patek. Eventually, we ran it for about a year. Now we are seeing a pretty strong traction where now payrolls are embedding finance within HRMS systems. So within embedded finance, there are two concepts: be present where customer is present, right? And financially, and if you can offer offer products where customers are present. So that's one space that we picked up, and we thought, people spend time on their work platforms. People do look at, their HRMS systems once in a while, if not daily at least. So we thought, why not start offering or create a marketplace around that? And that's where we started offering a bunch of financial insurance and other products right there. So that's another space of distribution that we are creating through the product Perks, basically.
Wow, fantastic example of stay inside, stay in mind. Yeah,
and the good part is we are not riding on public infra.
Yeah.
So it's slightly away from account aggregators, UPIs, etc. So we are trying to build a non-public infra riding on that ride because that's the play that we are doing.
Fantastic. Anant, your fintech focuses on democratizing credit by making it more seamless and hassle-free. Rohit talked about how that's a natural, way given where the profit pools and revenue pools lie. Tell us more about some of your differentiators, please.
Thank you. I think I'll quickly talk about what we do at Finbox. Especially when it comes to embedded finance, it's the way we look at it is lenders want to do more business, which is lend to more people. These people are traditionally acquired by lenders by reaching out to them via point of sales, through physical channels, through digital marketing on their own apps. But now, more and more as India gets digitized, more and more borrowers are present on various platforms like where they transact, and these platforms could be super apps. These could be invoice generation apps. apps are marketplaces, loan marketplaces. What Finbox does is Finbox has built the infrastructure that connects these apps with lenders. And the borrowers, when they come to these apps, they can get access to credit and value-added services using Finbox infrastructure and not feel like they've left the app at all. So in the same experience of the app, I'm on a super app, and as I browse through a smartphone, I can immediately get access to a buy now, pay later service or an EMI service using Finbox infrastructure. I just heard, during GFF that account aggregator powered loans of about $750 million. Finbox currently is at the same, throughput, which means that we currently power around $750 million worth of loans in this embedded finance, methodology. A part of, doing or getting this transaction through is helping lenders understand their borrowers' profile, their creditworthiness in a seamless way. So along with this infrastructure, what we've also built are credit intelligence or data products, which help lenders ascertain the accurate creditworthiness of the borrower, the income, accurate income of the borrower, and various profile parameters like demographics, address. So in that sense, we've also built what is an API marketplace where I think Pramey, Amit are potential partners for us. So that way our infrastructure in a way is connecting the various stakeholders to make credit available seamlessly and at high throughput. This is what we're doing, and we're really looking forward to great growth. So a statistic here is that lenders currently are looking for this next 12 months about 40% increase in their lending. This increase will be powered by embedded finance to the tune of 10%. So, that's quite a big number when you look at it. That 10% of the growth will come from embedded finance, like features which Finbox and my co-panelists are powering in some way.
Fantastic. Thanks, Anant. So look, before we get into the intricacies of embedded finance, let me admit that this is a topic where at least we see very polarizing views in the industry. For example, one of my friends, and client who's the CTO of a large government-owned bank argues that there is not much in it for his bank in this idea. His point of reasoning is essentially that, they already have crores of customers with them. So their focus is more around milking those customers than to acquire newer customers who he argues will be profit diminutive, in the sense that many of the platforms will end up eventually, taking up hefty margins, leaving very little value on the table, for his bank. He feels that, given the legacy nature of his tech stack, it will also require considerable investment to make them integration friendly as well. On the other hand, there is another client who is a digital head of a mid-sized private sector bank, who's actually seen very strong results from this initiative already. In fact, as we speak, there are active discussions in his boardroom around how do we now monetize that customer who we have acquired through these platforms fully by converting those single product relationships, so to speak, into multi-product opportunities. And therefore, that person is on the extreme end of, optimism with respect to the trend. Given the counter directionality, so to speak, of these views, I am sure, we have an interesting discussion ahead of us. I think my first question, is to you, Rohit. How do you see this opportunity shaping up? How bullish are you on this opportunity? And what are the key trends backing your line of reasoning?
Sure. So let me take you back in time, right? And I'll tell you a story from maybe like 50 years ago and then a story from 6 years ago, right? 6 years ago is obviously my personal experience, 50 years ago won't be mine, but yes, still valid story nonetheless. When the first card networks came in, right, so American Express was legendary when it came out, and Visa, MasterCard, of course, created their own amazing business lines. It has gotten to such a level where now, as a consumer, your affiliation is no longer with the card network. Do you agree? Yeah? Like most people don't even remember how many Visa cards they have, how many Amex they have, how many, MasterCard they have. They swipe that card 10 times in a day, they still don't remember which card they swiped, right? Except the bank. My prediction, and I am willing to place a large wager on this as well, personally, if you love that. 10 years, even I would say even faster, maybe 5 to 10 years down the line, people won't remember which bank card they swiped, right? The bank branding will go into oblivion. What I mean by that is, banks will obviously stay relevant. There's like a whole different story on what banks do. But the branding will go away, right? What that means is the customer will not be affiliated, will not even remember which bank they bank with, right? It's already happening to a lot of extent, right? If you talk to the millennials. And embedded finance or rather embedded banking is exactly, I would say going hand in hand with that, right? And these are like two peas in a pod, which are happening simultaneously. So people will remember, okay, that I swiped my credit card, debit card, right? But not remember the bank. They will even be further more affiliated to the brand which issued the card, which will not be a bank. Again, classic examples of neobanks, happening around the world. In India, different story, multiple reasons, right? But that's the future. Now, interesting thing, what I've learned, and I'm sure most of people would agree, once wheels of tech, wheels of behavior, consumer behavior are set in motion and people start adopting it widely, there's no going back, right? Internet, one of the biggest examples. Of course, crypto, again, a big example. People have been trying to, dabble in crypto. There's no going back in that. It's not that crypto will go away, right? So these are like the macro trends to answer that second part of the question of, why, what I see as happening in the finance and the banking industry. Now, specifically to, what I feel I'm bullish specifically about, or like the specific trend which I see happening even more, in our conversations, with the banks, or rather with any lender, not just banks, right? The non-banking lenders as well. To add to Anand's point, I think the desire to grow supersedes everything else, right? I mean, ultimately, every business is being done to grow, right? So going back to that, the first example which you were giving of that particular, large PSU bank, which is resistant to those changes, perfectly understandable, right? But I would just say to that person, hey, it's futile, right? It's going to happen anyways, regardless of whether you are with it or not, right? And yeah, of course, to name a few large e-commerce companies which actually work with us as well. It's all public companies. A couple of them are public companies. A couple of them are, about to go public as well. If they are doing embedded finance, embedded banking at their scale, right? I don't see any reason why any bank would want to stay away from such an opportunity, right? So yeah, I think these are, I would say, two macro and micro. A quick small story on the second one, which I told you. 6 years ago, actually no, 8 years ago, when we were, of course, starting out, my pool-in, the integration timeline with a bank in India on simple IMPS, bank-to-bank APIs, was 6 months. The integration timeline today with a bank on the same APIs is 4 months. It has been 8 years, the timeline has reduced by 2 months, right? And I know that because I do this daily, right? So If that's the pace at which the banks are directly dealing, that's not the future, right? The future is somebody else coming in between, the embedded banking or the embedded finance provider coming in between, taking that pain away from the banks and the lenders and making it simple for the fintechs. Also, it's a win-win for them, right? Interestingly, most people don't realize there is a reason why the banking process is designed that way, because even the banks are taking a bet on that partnership, right? They don't know whether that fintech will work or not, right? So it's a time and money investment from the bank as well, right? So yeah, these are like, I would say, two stories which paint a trend in my mind of, yeah.
Sure, super.
Between this, engaging existing borrowers by the bank versus, being aggressive and going in for new, customers, I think, the former is more like an older version of the approach, with all of this digitization and public infrastructure that is getting created, and I'm talking about account aggregator here. Banks know that any platform or any other financial institution, if they acquire existing customers of the bank as well, now that new NBFC or bank has the ability to get hold of data of this customer and acquire this customer at attractive terms and potentially engage them through their life cycle, pretty much taking away the customer from the bank, right? So that is now possible, or it is now becoming possible. So and banks are aware of that. The other thing is the likes of Paytm, these marketplaces or fintech platforms are gearing up to let's say control in a way, or at least take over more and more part of the customer life cycle, and therefore a higher part of the customer value. Banks don't want to let that go, right? So I think the second approach, which is to go aggressive and let's say collaborate with the likes of the infrastructure players such as Finbox. What it does is it also modernizes their legacy partnership stack, which helps them accelerate their business, go aggressive, think of more business, less of prioritization, information technology challenges, and let's say failure rates of new endeavors, right? So I think what Finbox does is not just brings down the time to market by a fifth, but also ensures that whenever a new line of business is getting created, that hits success. So yeah.
Fair. So in a sense, what I'm hearing is embedded finance is inevitable. The size of the opportunity remains to be seen, but it's huge. My next question is to you, Pramey. We've been hearing and we've seen it over time. Banks have been relegated to the back end when it comes to payments. It is likely to also play out that way on credit, which also means that the profit pools will get fundamentally challenged, and perhaps we are looking at a scenario of lopsided allocation of the money that is on the table. What are your views on this?
See, so my response would be linked to one of the questions that you asked previously. See, at the end of the day, the supply of money, which is lending, we sometimes forget as a fintech that the custodian of money is still the bank. They have the cheapest form of capital available with them, and any embedded finance player or lender who's creating products outside, they will ride on top of the bank, right? So eventually, there will be a large pie that will go to banks, typically, who will supply that capital, etc. So I think that part is pretty essential. While the distribution layers can be there, so banks do command that, and we have co-lending regulations like FLDG and other things that are there. So eventually that also favors bank in a way that the money is secure, and rightly so as well, because at the end of the day, it's a public money that gets deposited. So the profit pool sharing will always, be, uh, again, go back to the core business models where the embedded finance is getting implemented, right? Be it e-commerce. So it will be driven by the type of customers they have, the, the segments they operate into, be it travel, be it hospitality, be it, any e-commerce, supermarket. So it really depends on the type of customers they own, right? A supermarket in tier 2 city or tier 1 city will have that customer segment, and that will drive the pricing, the profitability, and other things, right? So versus a metro city where people have cards and they're trying to offer better products there, etc. So the profitability pool will still be lean towards the custodian of the money, unless we have digital money, and now fintechs can also park money at themselves, right? So that one factor we don't have to miss out. And the more players who come as part of the distribution, who are supplying infra from tech perspective, people who are distributing, the margins will shrink eventually. And there's a X percentage that you can charge to a customer, and eventually customers also are aware that there are potential partners who can give us a better rate, right? So I think those equilibrium things will come, and I do feel the margins will shrink in future, but I think it really depends on the core business of the retailer or whosoever is offering the product, that what kind of customer segments they operate into, what kind of products they operate into. For example, travel insurance, or we are talking about Ola and all that, they can only sell micro insurance, right? So how much you can make in a particular trip. So it depends on the volume they do rather than the size of, I would say, the ticket size and other things. So that's my take. So while I do remember one of the quote which my Mr. Puri used to say quite often, not now, about 8, 9, 10 years ago, when people used to say fintech is coming, they will take away banks' power, etc. Still, banks are the largest profit makers. And he always used to make a statement. You want to make, paneer, shahi paneer or something, you can have the gravy, but I have the paneer at the end of the day. So you can't take away that fact. And so focus on your core business, customers, and this will always be a secondary line of business and a customer convenience thing that will come into play.
Sure. So when we talk about embedded finance, I think another interesting theme that shapes up is what we call as miniaturization, of credit, with ticket sizes getting lowered. Pramey talked about volumes, rising, and eventually it being, a game of scale and volumes. Amit, my next question is to you. In the retail finance space, which sectors or segments do you see ending up becoming disproportionate beneficiaries of, embedded finance?
You look at us as a country, we're 1.4 billion people. What we tend to sometimes conveniently forget is there is trillions and trillions of assets actually moving around on an everyday basis. Right from the smallest family of 2 or 3 will have something, and everything and everyone needs protection. To begin with, I think some of as the middle class mobility starts, and so does some of the other segments of Indian population, and you see a lot of asset buying happening, which is more, let's say, white goods and consumer electronics and so on and so forth. I think that is, in my opinion, one of the key segments that's going to keep on benefiting. I can talk a little bit more from an insurance perspective, wherein I believe that protection of those assets will be very, very meaningful, but from an embedded, lending perspective as well. Imagine, a lot of you would have heard about the concept of right to repair, and there are a lot of conversation happening around that. You go and talk to a lot of people who are selling these assets and tell them that you will have to kind of, respect the right of repair. They will suddenly start looking at their balance sheets and P&Ls and how do we do it. Now imagine if you have very small ticket items in terms of embedded insurance out there. it starts giving coverages, and then consumers start having much better benefits of everything. Uh, I think agriculture is going to be one huge playbook as well. If, ask me, last year I think it was about $250 billion in agri lending. Ideally, it should be about $38 billion in insurance as well. All that it was about 3.7 billion dollars. The reason, the cost of figuring out what is the insurable interest, how will you do yield assessment, and so on and so forth. So to connect to one of the earlier things we were talking about in terms of profit pools, I think you will see movement on profit pools also moving into how is the technology and embedded technology especially going to change the productivity caricatures of these balance sheets. The more these productivity metrics change, more is the ability to spread the profit pools very well, and while making sure that you have a very interesting pricing waterfall that fundamentally still drives a significant amount of penetration. So I think these are some of the areas where I think there will be significant amount of movement, and embedded insurance particularly will be very, very meaningful, but so is embedded finance as well.
Sure. We have a lot of credit representation in the audience as well today. Especially from their standpoint, I think I have two specific questions, in fact, for all of you. My first question is, we spoke about this being an interesting opportunity to modernize legacy tech. Day in, day out, I'm sure many of you who work with large credit providers face integration challenges. Any specific success factors, or best practices you've seen, some players do well, which could set up the industry up for success in a big way? Maybe Rohit, we will start.
Yeah, it's basically the process, right? So the process of integration, the process of discussion, the mindset that that partner has, right? That makes a difference. It's not a revolutionary difference, like as I gave you the example of those timelines. It's marginally improved in a few years. But yes, it's definitely an incremental difference, right? Which helps nonetheless, right, to us and our companies. Yeah, so I think a great way to look at it is what exactly the integration looks like. So if you talk about embedded finance or embedded banking, we're looking at integrating with a layer. It's basically an API layer which sits above the core banking system, right, of the bank. In a lender's case, it's a whole different thing. They have the LMS, and then the LMS either exposes the APIs, or the lender develops the APIs themselves, or they hire somebody else to develop those APIs. At the end of the day, it's pretty much a third party, which may or may not be affiliated with the lender directly, right? That's the integration point. Now, one is how good are those APIs? How well are they maintained? That's a major breaking point. Most of the times, those API documentations are not maintained well. There's just some PDF maintained in some local desktop or laptop with some guy sitting in a remote corner in the country, right? And then a new partnership comes in, and then they have to call up, hey, get the latest PDF, So that's very easily rectifiable, right? If somebody just takes care of that in the organization, just like keeping the documentation up to date on the cloud, digitally available, not that hard. So again, goes back to mindset, right? So it has to come top down. The second is the speed of pushing that integration through, right? So how quickly do you want it to take, go to market? Again, very top-down approach. It has to come from the head of that, digital banking unit, or the head of digital lending unit, from the lender. I think if you get these two things well, yeah, these are two critical success factors. Yeah.
Amit, your thoughts on this?
Yeah, I think, API integrations, and trust me, coming from insurance side, we live a bit of a nightmare on that side on an everyday basis. There are 2-3 sides of it. I think supplier side APIs, their own tech infrastructures tend to be a mess, and banks are years ahead of insurance companies. And when I say years, I mean like some of them are probably decades ahead of them, right? But I think the other side of it is that the complexity of the core product itself, right? I mean, API is a digital representation of what is the core product that you're looking at. And as you look at the complexity being, mirrored in terms of an API, you've got to be very mindful of what is the real flow, how is it working, how is it not working. Somebody mentioned, for example, a group insurance product. Your group insurance product can be a 4-line API, honestly, right? But if you're doing a life insurance product, you're looking at a 40-page document, that is going to take you 4 months to figure out. So I think it needs both sides from a supplier side, obviously for them to look at how do they make it, and probably drive some degree of industry standardization around it. And but on the other side of it, for service providers such as us, to be very, very cognizant of what the degree of complexity of the product is. How do you really manifest it in terms of what is the kind of CX it will drive out eventually? I think if these three lines are clear, I think we have got enough smart software guys in India who will do a reasonable job of kind of integrating them.
Anant?
Yeah, I think just agree with both of them. But the way things are going, the number of digital transformation projects that you are also perhaps seeing and observing in the market, the way RBI is coming in and wanting lenders to modernize their legacy infrastructure, I think this is the direction that things will take. It's an opportunity both for the legacy software providers to modernize their products, and players like us, who essentially are when we integrate with a lender to embed finance, we actually become a system of record for the lender as well, and this is something that also helps the lender from a RBI compliance reporting point of view, because RBI, going ahead, RBI wants lenders to have the ability to do more and more real-time reporting of the loan statuses, so on and so forth. So yeah, we see this thing also as a huge opportunity for us. Just on the previous question, my friend Pramey mentioned that when more stakeholders enter, margins tend to decline. But I think when in this initial phase, embedded finance also has an effect of adding efficiency into the process, right? So today, for example, a Kirana shop owner, if he has to be given a loan, a lender like IIFL, for example, who's one of our partners, will have to essentially go to that Kirana shop owner, do a PD, collect a lot of documents, then take them back. Then there'll be some manual underwriting, perhaps some documents are missing. There'll be back and forth, right? What this does is, adds 2 to 3% extra in terms of cost of acquisition. Vis-a-vis if the same merchant is on a Vyapar app and perhaps Finbox as an embedded finance partner is powering loans on that app, again powered by IIFL, all of this happens seamlessly, or most of it at least. So what then lender sees is lowering of their cost of acquisition as well, which is what, let's say, flows to Finbox. A part of it flows to Finbox or any other infrastructure player as such. So initially, this addition of efficiency is what would what we see as giving the infrastructure players like Finbox a percentage point. This is more like an MSME example. Another large NBFC managing director told me that when they do digital marketing, their cost of acquisition is anywhere around 8%. And when they would partner with us, and we'd originate on another platform, this cost would come down to 3% odd for platform, assuming, and a percentage point for Finbox. Then it still halves the CAC for the lender, right? So I think embedded finance, at least for the next couple of years, is creating a solid win-win for all stakeholders.
On a lighter note, pleasantly surprised that we are almost 30 minutes into the discussion and the word regulator didn't come up. That's not very common in conversations with fintech entrepreneurs. But on that note, Pramey, What's, if you had to pick out 2 or 3 imperatives for regulators or policymakers, what would those be?
I mean, they're already doing their job, right? So I don't know what we can suggest to them, but
Something that advances the agenda of embedded finance, maybe.
I mean, I think there are a lot of things pretty much in place, and or I think they're already moving in direction where it will be in place, and you know, a lot of times we as entrepreneurs do expect that these are basics, it should have happened, or it should happen that way. But you know, coming from banking perspective, banking background, etc., I've seen why some things happen and why things take time as well, right? So it's hard to take decisions very quickly, and eventually something goes wrong, then it's a bigger risk basically than it can happen. So I think one thing that regulators have to think about is they have to create more space for innovators, right? You know, while we have a solid infra, public infra that is available, but you know, I feel there's a lot of push on that, probably over push, I would say, but it's required to get things done as well. So it also create a, you know, a pressure for the adopters of you know, adopters of these services to prioritize those things rather than the innovations thing that are happening. That is one thing that you know, that is something that is needed. The second thing is on the regulations. I think sometimes we do feel through our partners as well, you know, the transparency on some things that is missing, right? At times when they I remember last year, September, similar time, there were certain regulations. And for a couple of months, a lot of folks were confused, what is right, what is wrong, etc. Right? So I think probably those two things are pretty important. Creating more space for newer innovations. And the second thing is a bit on transparency bit, which can help the entire ecosystem to sail through together and foster more innovation, basically.
Sure. I guess we have just about enough time to take, you know, last couple of questions from the audience, maybe.
Mehra. So we are building Chat GPT of finance. So my question from the ground, अगर जब हम किराना वाले के पास B2B buy now pay later लेके जाते हैं ना, he has n number of questions. He's a very down to earth guy. अपने operations में फंसा पड़ा है. तो जब नए products आते हैं ना, embedded finance and so on, उसको jargon नहीं समझता, to be honest. तो हम कितना भी अच्छा technology बनाएं, his life has to be made very simple. You talked about transparency. तो उसको simple चीज़ समझता है कि इतना loan है, इतना पैसा देना है. Right? And those answers, let me tell you very honestly, I try to search personal loan on all the banks. आप website पे जाओ, personal loan देखो, उसके अंदर जाके देखो, then see salaried and so on. It doesn't work even for me and not even the audience here. So where do you see the conversational AI, the generative AI, automatic code generation, where people can ask question? We can ask what is the personal loan rate of this product? Simple. End of the story.
I think you are talking about, you know, one is how to simply make the product available for the consumer, right?
Yes.
How easy for him to understand the product at the very first place.
Yes.
So there are two sides to it, right? One is how is he, you know, looking for the product? Is he looking for the product himself, or is he looking at the product, let's say, at a Vyapar app, right? So there the onus is on, again, Vyapar to app basically to actually make it easier for the customer to be able to understand the product better. And when he's approaching himself, the onus is basically, again, with the banks and everybody to make it easier. So this is where I think the products like something that you're building can definitely help, and you can actually partner with them and integrate that, hey, customer experience, transparency of, you know, exposing information to the customer, how easier for them to understand the product and those kind of things. That does play a big role. It's actually part of the entire customer experience bit. So definitely I do see future is here, and thanks for the new technologies that are coming up. That will, I think that could be the next wave in terms of how the experience of the customers can grow up. I'm certainly very positive about these things that will come up.
Sure.
I think there were, in past things have been tried, basically creating chatbots, etc. But I think they were not as efficient as it can be now with some of the things that are there now, like ChatGPT and a few other things that are there. So definitely, I think probably now is the time to build those services better.
Sure.
And create more opportunities again on that side.
Also, in a way, I think, this information asymmetry also pushes the case for embedded finance, because many of these platforms understand the pulse of the customer better than, banks or credit providers ever could. Right. So, in some sense, that's also,
I can add to this. So, to your point, and I think what got addressed was pretty much to your point, and I think then Ankit pretty much said the next part of it, how the conundrum of that gets solved in a way.
Yeah.
See, we have done something similar. We are about to release that product in next week, 10 days time.
Uh-huh.
Our intent was that how do you simplify this conversation, not only for the buyer of the insurance product, but also for the seller, right?
Yes.
The seller is the one that gets blamed mostly for mis-selling.
Yeah.
The buyer only figures it out at the time of claim. So we have tried to build something in which you can fundamentally ask a question even to a degree of saying how much of a protection gap do I have. So if I'm picking up a product, it's not only for is this a good product, bad product for me, because in India, for example, they say on the health side, there is still a 70% protection gap. So how do you kind of go and get a response to that for some of the options that you have in front of you, and then get a very pointed answer or recommendations in terms of what will help you cover that protection gap, right? Because if you're going to spend money, if you're going to get a financial product, you may as well as get what really works for you. And that micro segmentation, I think, with some of the products that, like you are saying you are doing, or we are trying to build on our side from an insurance perspective, is very, very valuable for masses and not very specific few.
Yeah, for sure. Thank you. Have a nice one.
any last questions from the audience?
Hi, this is Dhananjay. This is a question, Dhananjay from Finbox. This is a question specific to Ankit. The query is that you have visibility both from the lender side or the service provider side, and you have both access or connectivity with those customer touch points. So what are those key trigger pointers that you think that absorption of this embedded finance could be, if we see after 2-3 years in hindsight, yes, these are the 3-4 pointers that have driven this good, both on lender side and in terms of acceptance on the customer touch points side as well.
Your question came back to you.
No, glad to answer this. I think, look, in our view, there are 3 fundamental drivers that will push this. The first is, and I think the more underappreciated part, is that we have as a nation pursued digital public infrastructure much more aggressively than any of the countries around us that we know. That in itself is a very, very compelling driver to us. You look at platforms like government e-marketplace today, or what is envisaged for ONDC to become in days and months to come. Now that itself is a very, very fundamental driver that sets the bedrock for success, as far as we see it. I think the second, point is, triggered by the discussion we just had. There is massive information asymmetry and customer, sort of misconception or perception about financial products, which, some of these platforms are much well placed to solve than the credit providers or the insurance providers themselves. That itself is a very big, plus point. I think lastly, we are a nation where competition will always be there across all industries. There will always, from the supply side perspective, be a scenario where entities are competing to get customer, mind space, right? And that mind space will not be limited to saying, these are the products that are available on the platform, and that it will never be limited to those products. It will go much beyond those products. And therefore, if I'm a large e-commerce player, I am never thinking of providing the next best book to the customer. I am always thinking about the full customer wallet, which, by the way, has a very significant part on the financial side, or which is likely to grow even faster than the consumer side as well. So I think, to us at least, these are the three more fundamental drivers. They will be supported with a lot of other factors as well. But those will be the three most top of mind drivers to me. Yeah.
Really behind time, but thank you for doing this with us.